Well, we just look at the return ratios such as the ROE. They are very important in terms of helping us to understand the profitability and performance of the company. But they don't give us much idea about the risk of the company's profitability. So we need some ratios to help us understand both returns and the risks. And for that, we can turn to the market prices, because usually the market price of a company stock is based on the investor's perception of both returns and risks in the company. So if we look at the stock price comparing to the company's, for example, profitability, we can see how much would the investors be willing to pay for the stock price given the profit the company is making. So that's why we are looking at the market value ratios. The first one we look at is the PE ratio. This is one of the best known market value ratios. That is about the price investors are willing to pay per dollar of the company's EPS. If you remember from chapter 2, EPS is the earnings per share, which is the net income divided by the number of shares outstanding. So the PE ratio is simply the P, stock price, or say the market price per share, over E, earnings per share. So both of them are on a per share basis. PE ratio, if it's very high, usually that means investors think the company has pretty good growth potential. If a company has high PE ratio, we say its stock is one of the so-called growth stocks, and low PE ratio stocks usually are considered as the value stocks because their price is relatively lower comparing to the EPS that they deliver. We can also look at the MB ratio, or say the market to book value ratio. It's about how much the investors are willing to pay for the stock per dollar of the company's common equity. So it is the market price, or say market value per share, divided by the book value per share. Again, both of them are on a per share basis. And the book value per share is the book value of the company's common equity divided by the total number of common stocks outstanding. So to calculate this DPH Tree Farm Company's PE ratio and the MB ratio, we look at the income statement. At the bottom of the income statement, earnings per share is $4 and the stock price is 17.25. So 17.25 divided by 4, that gives us a 4.31. So price is about 4.3 times of the company's EPS. That is indeed a very low PE ratio. We can also calculate the company's MB ratio. Price is 17.25. Book value per share is 12.5. So that means the company's market value is about 1.38 times of the company's book value of equity. If you don't remember how these numbers were calculated, you can actually go back to chapter 2 lecture and review how these ratios were calculated. Now let's talk about the DuPont analysis. DuPont analysis is not really about a new set of ratios. It's more about using whatever we have learned so far about different groups of financial ratios to explain ROA and ROE of each company. We can look at this basic DuPont equation. Basic DuPont equation is about ROA, and we can write ROA, which is return the net income available to common stockholders over total assets. And that can be decomposed into profit margin multiplied by total asset turnover. So how does that work? We can actually go to the next slides. Now let's look at the right-hand side. Profit margin, by definition, is net income over sales. Total asset turnover, if you remember from the last video, is sales divided by total asset. So we can actually now have sales and sales cancel each other. We would have net income over total assets. and that is exactly the definition of ROA. So that is the basic DuPont equation. ROA equals to profit margin multiplied by total asset turnover. Why do we break down ROA into these two different ratios? Because that way we can look at the profit margin of the company and total asset turnover of the company and see which one of these two contribute to the increase or decrease of the ROA. We can also look at ROE. The full DuPont formula is about ROE being broken down into three different ratios multiplying each other. So to understand that, again, let's go to the next slides. ROE is return on equity. Now, if we look at the profit margin, which is net income over sales, total asset turnover, sales divided by total assets. If you remember from the debt management ratios, equity multiplier is total asset over equity. So now sales and sales can cancel out. Total asset cancel out. We would have net income over common equity on the right hand side, and net income over equity is exactly the definition of ROE. So that's why by the full DuPont formula we have ROE as the product of profit margin, total asset turnover, and equity multiplier multiplying each other. And by the way, if you compare the ROA and ROE formula, so this is ROA. That means ROE can also be written as ROA multiplied by the equity multiplier. Remember, when we first introduced ROE, we mentioned that high ROE is usually a good sign, but it could also be driven by very high financial leverage of the company. And now if you look at this equation, ROE being the product of ROA and equity multiplier, which is about debt management or say the financial leverage, now you understand why we say a very high ROE could be high ROA or could be very high leverage. So now if we summarize all the ratios that we just covered, we have looked different groups of ratios, including the liquidity ratios, asset management ratios, debt management ratios, profitability ratios, and market value ratios. Within each group, we talk about several different ratios. So it's important that you understand the definition of all those ratios that we covered in this lecture and understand how they are calculated and how they help to capture the financial health and performance of the company. We also need to understand that we need to be careful when we look at the ratios. Remember, for example, in the liquidity ratio section, we mentioned a high liquidity ratio could be a good sign, but it could also suggest losing the opportunity of making high returns. High inventory turnover ratio could again be a good sign, but it also may suggest the company inventory level is kept too low. So we need to be careful when we interpret the ratios and use the ratios to understand the company's operations. Now let's look at some other aspect of the ratio analysis. First, we look at the so-called spreading the financial statement, or say the common sizing of the financial statement. The concept is pretty simple. Instead of looking at dollar amount in the balance sheet and income statements, we try to look at all those accounts on a percentage basis. For example, if you look at this sample common size income statements, you understand that a regular income statement will give you all these dollar amounts. For example, sales revenue will be $100,000. Gross profit will be $50,000. But in the common size income statement for the same company, each area line will be about the percentage of that account over the sales revenue. So for example, the selling general administrative expenses being $10,000 over $100,000, that's 10%. That's why we have 10%. This is saying the SG&A expenses is about 10% of the total sales revenue. And then after you subtract all the expenses and costs from the total revenue, net income is about 32% of the sales revenue. And by the way, this actually also tells you that the company's profit margin is 32%. You can also say the company's gross profit margin is 50%, operating profit margin is 40%, and finally the net profit margin is 32%. Again, the numbers on the common size income statement, they are all about the percentage of each account over the total revenue. If you are looking at a common size balance sheet, all those numbers will be about the percentage of each every account over the total assets. After we got all those ratios, we need to analyze those ratios in a meaningful way and compare them to some benchmark. So if we compare the same ratio for the same company over different times, we are doing a so-called time series analysis. So for example, if we look at the profit margin for Walmart in the past 10 years, we are performing a so-called time series analysis to see whether Walmart's profit margin has been improved over time. If we look at the same ratio across different companies, okay, or say one company against the other companies, usually in the same industry, we are doing the so-called cross-sectional analysis. You understand it's more reasonable to compare the companies in the same industry, otherwise the comparison itself is not meaningful. For example, you cannot compare the profit margin between Walmart and Apple and say Walmart's profitability is not as satisfying as Apple's, because they are two totally different companies and in two totally different industries, and their profit margins are just not comparable. Some extra points about the cautions we need to take in looking at those ratios. We need to understand when we calculate those ratios, we're using the data from the financial statements. The financial statement data, they are historical, or say they are about recording of the past. So looking at those financial statement information and those ratios can only tell us what have happened in the company, and it's not really giving us direct idea about what will happen in the company. If a company uses a different accounting method or approaches, the different accounting method can affect the numbers in the financial statement, and in turn they will affect the value of those ratios. So for example, if the company uses the LIFO versus FIFO, the inventory balance will definitely be affected, and then when you calculate the inventory turnover ratio, your ratio result will be affected. And when we look at the financial ratios of different companies in different countries, non-US companies, because they do not use the same accounting standard that we use here in the United States, sometimes we cannot compare the ratios directly. Another thing we need to be aware of is that in a lot of companies, the sales revenues and expenses, they may be seasonal. So for example, if you see a company's inventory turnover in the last quarter of a year is better than the inventory turnover in the third quarter, you cannot draw the conclusion that the company has improved its inventory management. It may simply be because of the holiday season that drives a lot of sales. The last point is that sometimes companies may try window dressing or other ways to manipulate the financial statements and make the financial statements look better. Now, if the numbers on the financial statements are made better, then of course the ratios will look better. But we need to be careful whether the better looking financial ratios are really based on the improvement in the company's operations, or is it because of some manipulations or distortions. So this is chapter 3. Again, we talk about a lot of financial ratios, and for each ratio that we discussed here in this lecture, you need to understand the concept and understand how to calculate them, and also for some ratios, understand the connection among those ratios. And we also need to understand that ratios can help us understand a company, but we need to be careful when we look at the ratio results.